line. So today we have a great class for y'all. It is a part one of a two-part series, so definitely stay tuned for the second part that we'll have coming up in May. But today we have Rosch Wadera, who's going to be talking a little bit about underwriting and, equity versus what a... For now, I'm going to quickly jump into some announcements while our attendees get seated and our speaker gets mic'd up. But for those who don't know who I am, my name is Sarah Shalom. I'm our communications manager here at Quest in our Austin office. Been here for about 6 years, love working in the marketing department and sharing all the great resources that we have in the way of education about self-directed IRAs. So tonight is, of course, our self-directed IRA social, but this event we have every second Tuesday at 6:30 with the presentation at 7. But if you are unable to make it to the Austin one, we also do these events in Houston and in Dallas as well. So Houston's is the first Tuesday, and Dallas's is the third Tuesday. So first, second, third there. But we also have a lot of other events as well. So we do a Tuesday webinar. We have our self-directed IRA Saturday. We've got National Networking Happy Hour, and then we also stream them live, so you can always go back and rewatch them. But the Tuesday classes are designed to kind of be Quest education, self-directed IRA knowledge, and then all of our self-directed IRA Saturdays and the lunch and learns and the socials, we try to bring in guest speakers to not only talk about, private investments and non-traditional assets that you can hold inside of a self-directed IRA, but also just investments that you can do as a regular investor without a self-directed IRA as well. But like I said, if you like the information in this class and want to maybe watch it again, or you want to share it with somebody else, you can always go back to our YouTube where they are recorded and saved. So we have a couple of special events every now and then on top of the free events that we host. But the next one that we have coming up is the Masters of Tax Avoidance Bootcamp. These are just a few of the speakers that we have confirmed, but we actually have about 5 completely brand new speakers that have never been on the Quest stage. So we're really excited to bring them out for their debut, as well as a lot of the known experts that you're familiar with, and some just some kind of fresh faces that we want to give another platform for as well, because they've got some good education. So right now we do have early bird tickets on sale. It makes them, I'm pretty sure that they're only $75 right now. And if you are a client, you get an additional bonus, $50 off that $75. So it makes the tickets only $25, which is a great deal for over 15 speakers that are going to be sharing keynote information, panel information, talking about passive investments, diving a little bit deeper into oil and gas, and then, of course, covering some of the information that you'll need to know in preparation for tax season, which is underway right now. So get your tickets for that. You can scan this QR code, or if you are super interested, maybe on the fence, I may or may not have some golden tickets that I can give away tonight that will give you a free ticket. So if you are interested, come talk to me at the back. I'll see what I can do. We have our refer promo, of course. If you ever know somebody that might benefit from a self-directed IRA, you want to share the benefit of Quest with them, want to get them started, this is always running, so you'll get a credit towards your account, and they will also get a credit towards their account. Just a little bit of an incentive to say thank you for, getting them started with us. And to let them know that, we appreciate that they're starting here. But on top of that, now I don't have my slide, but we also have a very special promo that we have going on right now, and we call it our Texas two-step. And the reason why is because if you open your account and then you make the contribution, so those are the 2 steps, we're actually going to give you a free $125 that can go towards your first transaction. So normally it's $125 for that transaction. That'll be completely waived with the two-step promotion. So you open your account, you move the money in, and we will completely waive that first fee. So we're going to post that in the chat for those that are online and maybe not paying attention to the screens because we don't have it up here. But that promotion is called Two-Step 23. So feel free to take advantage of that. That's a great one that we've got. But if you have any additional questions, you maybe didn't catch any of that information, you want to learn more about our events, just anything else I haven't covered, you can always contact us. We're always available Monday through Friday, 8:30 to 5:30 Central Time, via the phone, the email, live chat feature, or the free consultation Calendly link that takes you directly to our consultation page where you can pick a time that works for you and you can talk to us about anything. 15 minutes, 30 minutes, I'm pretty sure it goes like up to an hour. So definitely take advantage of those outlets. But without further ado, that's all I've got. I'm going to go ahead and bring up our speaker, who's going to talk a little bit about underwriting. So let's give him a big round of applause. And here's your clicker.
Okay, so mic is on? Sweet. So this presentation is really just on the basics of underwriting. Basically trying to distill, we're not going to get into any sort of complex financial models. It's not really necessary, but we will go through the underlying foundational concepts of those models. But the goal really for this presentation is meant for the passive investors, specifically in multifamily syndications, but really the same concepts apply to all of the different real estate asset classes, to where a passive investor could intelligently, confidently, and quickly decide between all the different deals that are presented to a passive investor by the multitude of multifamily syndicators that are out there today. And kind of sort through all the noise so that you can allocate your capital in the best way possible and get the highest risk-adjusted returns to maximize your net worth and financial security. I suppose if I'm speaking in front of you all, then I should also introduce myself, give a little bit about my background. So I graduated from the University of Texas here in Austin. So I'm a Longhorn and an Austinite. First job was actually in oil and gas investment banking in Houston, Texas, a firm called Parks, Payton, Hepfel & Brown. They focused exclusively on oil field service contractors and equipment manufacturing companies. So what we did over there was we valued these companies and then sold them to private equity funds, which was just a great training ground in financial valuation of assets. Not specifically real estate, but a good overview. Shortly after that, worked for a public works contractor in Houston that did smaller development projects. So these were buildings smaller than 50,000 square feet, exclusively for government agencies. So the city of Austin was one of our biggest customers, completed 3 commercial buildings for the city of Austin, 5 commercial buildings in total while I was with that contractor. And then from there, took a gig with a multifamily syndicator that had 220 million assets under management. So it was about 10 or 12 apartment complexes while I was there. That came out to 2,224 apartment homes under management. I was the director of investor relations for their privately held REIT. So a good overview from the technical to the investors facing side. More recently, and currently, I work for a company called All Trades Industrial Properties, which is based out of Dallas, but has an office here in Houston. So All Trades is a developer of industrial buildings. They've put up a number of sites in the DFW area and have plans to expand. But today I'm not speaking on behalf of All Trades Industrial Properties. I'm actually just speaking as an individual, which means that anything that I express, any views or opinions that I share are mine only. None of All Trades or any of my prior employers. It also means that I'm not here to sell you anything, or do any sort of self-promotion because there's nothing that I can get out of this other than just the real reason that I do these things is to meet people, investors such as yourselves. For example, I met Scott Reese over here at one of these meetings a few weeks ago, or a few months ago now, who's also in the development space, another gentleman who develops a number of commercial properties. And through these meetings and meeting investors such as yourselves, it's opened up a lot of investment opportunities to me, which has really made a difference in my personal portfolio that I wouldn't have been exposed to. So on that note, before I jump into the presentation and we get into the underwriting and the technicals, I actually kind of want to take a chance to go around the room. Not everyone has to go, but if there's anyone that wants to share, if you work in the real estate profession, kind of what your company does, or if you're a real estate investor, what your journey has been like. Kind of be helpful for us all to network with each other afterwards if we just share with each other before I get started who we are. So any volunteers that want to get started first? Please.
My name is Andrew Black. I work for Novak Capital, part of Novak Brothers Development up in Georgetown. We build high-end commercial real estate, so from wrap apartment complexes, senior living, high-end hotels to storage and office. And so my role in the company is looking for passive investors who have interest in being involved in real estate, not only passively, but also on the development side for equity appreciation.
Awesome. And does Novak develop exclusively in Georgetown, or?
No.
Okay, so it's all across Texas, or?
Yeah, I mean, most of it's in Georgetown right now, but we've got some stuff in Oklahoma. We got some going on in Waco. We got stuff in. We're looking to do stuff up in Dallas.
Yeah, I've heard good things about Georgetown. We look at a lot of the different markets within Texas daily, and Georgetown consistently comes up as one of the fastest growing markets within Austin, which is already one of the fastest growing cities. So it's definitely a hot place.
It was the fastest growing city in the country last year.
Yeah, and also has one of the highest median incomes. Am I right?
I believe so.
Yeah. So anyone else would like to share? Scott, I'm going to pick on you.
Sure. Scott Reese, work with Courts and Construction. I'm also a qualified investor in real estate. All my investments are in real estate and real estate development. We're a developer focused on Lago Vista and Lakeway, and we've been developing almost exclusively townhomes and condominiums out there. So duplexes, quadplexes, and a few single-family high-end homes. We are busy looking for more land to buy.
You and me both.
Yes, sir.
And sir, I think you had your hand raised.
My name is Dayun Pinckney, single-family home investor, just purely for education.
Okay. And are you interested only in single family,
No,
or?
I'm actually interested in, I'm currently single-family, I'm interested in multi-units.
Okay. Okay, great. Yes, ma'am.
I'm Michelle. This is my partner, husband, Rick. You can speak for yourself if you would like, but we're with Bisco Capital, and we focus on single-family and residential mortgage loans. So we buy notes and distressed properties, and we focus on converting everything into paper and helping investors build their portfolios backed by paper and real estate.
Okay. So someone would come to you to invest in notes or to originate a loan? To invest in notes. Okay. Okay, great. Yeah, so I mean, in this room already, we have a pretty good mix of commercial development, single family, and then not just on the equity side, but also on the debt as well. So I think actually the feedback from you guys during this presentation will actually make it even more informative for the viewers online. But without further ado, let's go ahead and jump into it. Okay, great. So investing is buying, but what are you buying? I guess everybody thinks about investing a little bit differently. I think most people think of it very simply, which it is buying low and selling high. So if I buy an asset, whether it's a debt instrument or a piece of land or an apartment complex for X, I intend to make money in the process by selling it at a later date for X plus Y. But I like to take it a step further, which is, why does the price of an asset go up in the first place? If we know what makes an asset more valuable, then we can better allocate our capital and probably get higher returns in our investing journey. So generally, what makes an asset more valuable is an increase in its underlying cash flow. There are other things that will inflate asset prices, like low interest rates, or in the case of real estate, in addition to low interest rates, a high growth area where there's a lot of population that's going into an area with a finite amount of housing supply or real estate buildings that will also bid the price up of those assets. But ultimately, one of the main drivers of an increasing asset price is its underlying cash flow, and it's increasing those cash flows. So this is why those multifamily syndicators, prior to the rate hikes, and I'm sure even after the rate hikes in this current interest rate environment, will continue to make money, but especially before the interest rates went up, that rehab would then increase the cash flow of those apartment complexes, which is why they're able to buy for one price and sell for much higher. So what are you buying? You're buying cash flow. So I really tend to think of investing as, and therefore underwriting as, tracking the cash flows. What is it today? What is it going to be 3 or 4 years from now when I try to sell? So in this example, starting from the simplest case first, which one do y'all think would be the better investment? Raise your hand if it's the 8% cap rate. Okay. Raise your hand if it's the 10% cap rate. Okay. So Rob, would you care to share why, just for discussion purposes, why you think the 8% cap rate may be a better investment?
Rosch, I'm a contrarian investor.
Okay.
I think there's something hidden behind the numbers that you're going to show us. And you're going to make me right. Am I right?
Actually, you are. You are. So,
I was like, there's no truth here. I'm like,
without any other information, if this was the only information we were given, yes, the 10% cap rate, look, it's more cash flow from that asset, and it looks like both of these assets have a stable cash flow. We don't expect any changes. Then, hey, 10%, I'll take that any day over 8%. No brainer. But, as Rob alluded, we'll take it to the next level of complexity when it comes to underwriting.
Well,
And
Rosch, the question is, what would you rather own and what would you rather buy, right? Those are two different questions. We want to own the 10% cap rate, but we want to buy the 8% and then turn it into a 10% cap rate. And then the apartment complex value is going to go to whatever, 112 million, whatever the net present value is in that particular market of the increase in cap rate.
Yep. So Rob already hinted to my next slide, and you hinted on the slide after that. So
Easy presentation.
I know.
Drinks for everyone.
I'm done, guys.
right?
Keep on going, Rosch.
So,
Good stuff.
okay, between these two, which is better? If it's the one on the top, raise your hand.
We didn't change anything.
Oh. There we go. So, top versus bottom, without being given any other information, you just had to make your best guess. In both cases, you've expended $100 million. But in one case, on the top, You get 10 million of cash flow after all expenses in year 1, but it dwindles down to 9 and then to 8 in year 3. Whereas on the bottom, it starts off at 8 and goes up to 9 and then to 10. So 1 was actually a higher cap rate, giving you a higher yield. That's the one on top. But you see as we drag it out into further years, it's declining in cash flow. So now I'll ask again. Easy questions, guys. If I was a professor, no one would fail. Top, better, raise your hand. Okay. Bottom, better, raise your hand. So, sir, I'm going to call on you to kind of volunteer and discuss with us. Why do you believe the top would be a better investment?
I get more money up front, and I can invest that somewhere else.
Okay. And
Cash flow.
yes. So I'll elaborate on that in a minute, but someone who selected the bottom investment, Andy, I believe you selected the bottom?
It's increased its cash flow, which should mean it's increased its value.
True.
And again, it's going to depend on what your strategy is.
True. So you're both right and you're both wrong because there's missing piece of information that I left out. And so you've each put in your own assumption as far as what that missing piece is, in which case you both would be right. So the gentleman on my left, you're absolutely correct. Technically, if all we ever received was the cash flows for these 3 years and we never got our money back, we never sold the property, technically this would have been the better investment. Although, to be fair, they're both pretty terrible investments. I mean, you only got 27 million back after 3 years. You never broke even after the 100 million you invested, but you did touch on the important concept of the time value of money. So although they both yielded you 27 million, the one on the top gave you that 27 million earlier. And assuming you're reinvesting it a larger amount earlier. So your internal rate of return would have been higher. But in reality, we would sell that asset at the end. It wouldn't just vanish. And where the cash flows are increasing, we would not only be able, we should be able to sell it for a higher price than what we bought it, with the justification being, look, it increases in cash flow every year. So you should purchase this at a premium, which is what Andy touched on. So again, both correct, just touching on different concepts. Both give the same, okay. So this is just reiterating what we just touched upon. So at the top scenario, 100 million you've expended. Again, a higher initial yield. So you would think that this is a higher returning product or investment, but because the cash flows are dwindling, you're actually losing a lot of value at the end when you liquidate the asset and get your money back. Lower cash flow, lower exit price. So we just lost 20 million off the top from 100 to 80 million, which is hardly enough to compensate for the interim cash flows. In fact, if we drag this out year 4, 5, 6, 7, or 8, and the cash flows continue to decline, probably by year 5, that IRR would not be positive. However, in this case, huge difference. 8 million, 9 million, 10 million. So same cap rate. We haven't changed the multiple of cash flow that we sell or buy for. So you're still getting the same amount of cash flow for dollar invested or exited. But because the cash flow is increasing, we're getting a pretty nice premium when we sell over here, 25 million over the 100 million that we had originally expended. So this answers the question of why would I accept a lower cap rate? So there's this trade-off. On one hand, we want the highest cap rate we can get when we buy. So if I was a note investor, for example, I want the highest interest rate that I could get, risk adjusted, which we'll get into later. But at the same time, it's perfectly justifiable to get a lower cap rate if there's also a high degree of confidence in the cash flows increasing over time. There's also a couple other caveats. If I have higher cash flow at the onset, and maybe the cash flow doesn't grow, but there is that added factor of I can reinvest those cash flows. So that's one advantage that a higher yield investment offers, the ability to reinvest those cash flows. Take for example, a tech startup versus a debt investment. A tech startup, I may be invested in it for 5 years and it has produced zero cash flow. Ideally, that's been offset by the fact that after 5 years, it's worth a lot more than when I had invested. Whereas a debt instrument, it might not have grown in value or in price because it's a fixed loan amount over those 5 years, but it's been giving me 10 or 12% of interest every year, which I then reinvest every month or every quarter, however often the payments are received, and that adds up over time. So there is that one advantage of reinvestment that yield has over growth. On the other side, growth also has another significant advantage where if all of your gains are deferred to the end when you sell the asset, there is a little bit of a tax advantage because I'm not paying tax on any yield. There is no yield. So although a high yield investment has the advantage of reinvesting that yield, it also has the disadvantage of that yield is going to be taxed. So your 10% yield, you might actually only end up with 9 or 8% after the IRS comes and collects their share. But then there's also the element of risk. So one other element I don't want to leave out, right, is at least with yield, like with the note investment, for example, I know I'm going to get that 10%, or at least fairly more certain that I'm going to get my 10% given the borrower's credit rating, as opposed to with a tech investment, that growth might sound very attractive, but it's not guaranteed. So that's what I think people refer to when they mention risk-adjusted returns, which I think now, with everything that's happened in the tech sector, people are starting to recognize the risk that's inherent in growth investments that was often neglected during the boom times. So for real estate, what are some of the things that we mentioned that drives up the price of real estate, that increases the cash flow? Would be a fixed amount of people, or rather a growing amount of people moving into a fixed amount of space. So in real estate, goes without saying, population growth is extremely important to us. This is why real estate in Austin, whether it's residential or storage or multifamily, trades at higher multiples than its counterpart real estate in Houston or San Antonio, for example, because Austin has that higher population growth, which would give the investor more confidence in his or her expectation that its cash flows will increase over time. So we're just going to look at, very briefly, population growth in Texas. I mean, we're all here sitting in Austin, so we already know this. From the Federal Reserve Bank of St. Louis, this is Austin for the last 5 years, 2.6% annually. So its population is growing at the rate of 2.6% every year. San Antonio, 1.4% annually since 2017. DFW, 1.5% annually since 2017. But what's interesting to note, DFW is 1.5% annually, and San Antonio, I just mentioned, was 1.4%. So more or less in line, similar in terms of population growth, but we also had to consider the fact that DFW is 3 times the size of San Antonio, at least based on the population within the metro area. So it's really adding a lot of people, which can give a developer, for example, some indication of where to build next and where to justify paying more for land versus where I should expect more of a discount for land. Oh, and Houston, 1.2% annually. So unfortunately, Houston's number 4 in our 4 Texas major cities in terms of population growth.
Don't tell Houston.
Yeah. Austin, then DFW, San Antonio, and then Houston. But overall, all the Texas cities are growing. So this is what Scott very intelligently alluded to earlier, was the cap rate that we're buying, but then when we sell, that premium that we can sell for based on the increase or decrease in the underlying cash flows. So for illustrative purposes, I put together 2 scenarios that have the same IRR to show, a high yield investment versus a lower yield investment. By how much does the low yield investment need to increase in cash flow to offset the fact that you're buying a lower yield investment? So in both scenarios, the one on the top initially is giving you more cash, which the gentleman was correct. That means that there's more to reinvest initially. Whereas the one below, that's significantly less cash. So in this scenario, that's $2 million less per year. We paid $100 million for this apartment complex, and it's giving us less than $2 million a year, or $2 million less per year than the scenario above. But just by increasing the underlying cash flow by only 2.9%, so it goes from 8 to 8.2 million to 8.5 million. Those are actually rounded to the first digit, but the point is it's increasing annually by just 2.9%. So we reduced yield by 20%. We went from 10 million to 8 million. That's a 20% reduction in yield. That's huge. But all it took to offset that reduction in yield and give us the same IRR is just a 2.9% increase in cash flow. So yield is extremely important. I'm a yield investor. But you can't deny the power of increase in cash flow. Just a subtle increase in cash flow really magnifies the value of the real estate, the sale price. And in this scenario, we're holding the cap rates constant. When you go to sell, you might be able to justify that, hey, this could sell for an even lower cap rate, meaning a higher price, if you could prove or argue to the buyer that rents or NOI could be increased even further. But forget that, just if we hold the cap rates constant, you can see the difference that subtle increases in cash flow can make. Another thing that is very important as far as why would cash flows go up? On one hand, yes, more people moving into the same area, but it's also important for us to know that, are those people making more money? There's a limit to how much you can charge in rent. You really can't go more than 30-35% of the tenant's income before you start running into some serious issues with collection, delinquencies, and also just unaffordability. That's not sustainable. So it's important for us to just quickly take a look. Underwriting, in this case, Texas real estate specifically, multifamily, what wages look like, and have they been going up? Because we know rents have been going up. So the other question is, have wages been going up to keep up with it? Fortunately, so this is Austin. Seems that we're doing well. Wages are going up. And just like population, the per person increase in wages in Austin is significantly higher than the rest of the Texas cities. It actually follows the exact same chronological order with Austin, DFW, San Antonio, and Houston, in that order, for population growth and wage growth. San Antonio, DFW, and Houston. So again, I mentioned this is the basics of underwriting, which is keeping it as simple as we can, cash flow, and tracking the underlying cash flows. Now I just kind of want to touch on, as a passive investor myself, some of the sponsor optics I've noticed, where a sponsor can show a higher projected return that might make his or her deal look better than, what's that?
You mean lie?
Exactly. Lie, but all projections, to an extent, you can argue are, I mean, they're certainly not facts, right, by definition. So one of the things for the passive investors I caution is to watch out for the trick of the sponsor showing a different exit cap rate than what they've entered in at. So both of these examples, we spent the exact same amount of money to buy the complex, $100 million, both on the top and on the bottom. And in both of the cases, they have the exact same amount of cash flow in every year, and that cash flow grows by the same amount in each year. So $100 million that we've spent to get $6 million of cash flow in year 1, 6.2, 6.5, but see the difference in the IRRs. On top, we have just 8.75%, and on the bottom, we have 23% basically. All the sponsor had to do was change the exit cap rate assumptions. So the sponsor on the bottom is saying, hey, I'll buy it at a 6 cap. Well, what I'm underwriting is that I'll sell it at a 4 cap. So that's kind of sponsor trick number one. And really the first question that I have as a passive investor to any syndicator I come across is, what are you underwriting as your entrance cap rate? And what are you underwriting as your exit cap rate? And if the two are different, then a conversation needs to be had as far as why are they different, or I just need to walk away and move on to the next one.
Especially in this market.
Right, tough market. So we're buying cash flows. We get why we would pay for a lower or a higher cap rate. Next comes financing the purchase of the asset. So basically, I've taken the modified balance sheet equation. So everyone knows the balance sheet equation is assets equal liabilities plus equity. But instead of showing the value or the price of those respective categories, I jump straight to the cash flows of those respective categories. So on the left, you have the asset. We may have bought it for $100 million. We may have bought it for $120 million. I'm most concerned in underwriting, especially as a passive investor, to quickly underwrite, to where I don't have to build a full detailed Excel model, but can kind of intelligently look at the main numbers and know, is this a good deal or not? Well, how much cash flow does the asset actually generate? In this case, $10 million. So we have a call out on the left. We paid $167 million for this asset. It was a 6% cap rate. So 6% of $167 million gives us that $10 million in blue on the left. That's our assets. So the cash flow that the assets produce goes to debt and equity providers. In this case, the annual interest payment is $5 million, so that leaves $5 million left over to the equity investors, me, the LPs, the GP, And then within that, there's a waterfall split, but for this purpose, we won't get into that. So you see here, let's just throwing out an arbitrary interest rate, which honestly isn't too far off from where we are today. 7% interest rate means that's receiving $5 million of interest annually, means that it's a $71.4 million loan. So the remaining purchase price of $167 million has to be financed with $95.2 million of equity. So you'll notice something here, which is, I think, a little bit of a mistake that a few people are getting into. Basically, this negative leverage scenario where the asset only yields 6%, but your interest rate is 7%. So how can you afford to pay 7% interest from an asset that only yields 6%? The only way you can do it is to take it out of equity. So we have to reduce the yield to equity to 5.3%. So you just have this very easy little equation. Assets cash flow on the left, how much goes to debt, how much goes to equity. Not just to see, are you solvent? Can you make these payments to both your debt and equity providers that you promised? But does it really make sense to use the amount of debt that you're using? So we'll look at the same asset. Again, $167 million purchase price at 6% cap rate, $10 million of cash flow. What if we just paid it all to equity, meaning we didn't have any debt on the asset? The yield on equity would be 6%. So we would actually make more as equity investors. In this scenario, it sounds crazy for me to say, but if the interest rates are higher than the cap rates, how can you justify using leverage and putting yourself into a negative leverage situation? So I think this is a big challenge that we're facing right now. And this is kind of why once the interest rates have gone up, there's just been a huge slowdown in transaction activity. And the only way to make a deal work would be to buy it all cash or get seller financing, where the seller gives you an interest rate that's lower than whatever cap rate they're selling it to you at. But if you use any sort of leverage, you could still remain solvent. You could still meet your DSCR coverage ratios, but would you be getting the highest yield on your equity as you could when you're in a negative leverage situation? And so the other way to make a deal work would be for sellers to lower their price, essentially giving you a higher cap rate that's higher than your cost of debt. And I haven't found a seller that's willing to do so just yet, so I wouldn't count on that either. But just for fun's sake, to reminisce on the good old times, we'll look at the effect of positive leverage when the interest rate is lower than the cap rate. In this case, just by 1 percentage point or 100 basis points. So 6% cap rate, same asset, same purchase price, same cash flow, but this time the debt, same amount of debt, but our interest expense has dramatically decreased because we're at a 5% interest rate. So now we're back into our positive leverage situation. So just like the good old times before the Fed raised the rates and we had a higher yield on equity than the bank is receiving, which is the way it's supposed to be. The equity investor is supposed to make more money than the bank. And just a final note on cap rates, it's definitely the number one way to value real estate, to buy and sell, to trade assets. But oftentimes people kind of fail to forget that cap rates are not set in stone. When interest rates were low for an extended period of time, everyone started assuming that, I could sell for this cap rate. but there is a relationship between interest rates and cap rates, which is apparent to everyone now. As interest rates go up, real estate values essentially go down. As interest rates go down, real estate prices go up. So in many ways, we like to think that we're all very intelligent, astute investors, and I'm sure we are, but we're all at the behest of the Federal Reserve. They kind of dictate asset prices in one way or the other. When they set the interest rate, that's a minimum rate of return that an asset needs to produce in order to be financed with debt. Unless you're purchasing it with all cash, then the interest rates may not necessarily affect you, at least until you go to sell it in the open market. But the reality is all the real estate, very little of it is purchased with all cash. So this is a little bit of a run-along slide, but I'll go through it pretty quickly. Basically, just wanted to share an update. I just read through the monetary policy report submitted by Jerome Powell in the Federal Reserve on March 3rd. So every 6 months, he has to give this report to Congress, an update on where he sees the economy. And now that we know how sensitive real estate and therefore financial returns are to interest rates, start paying a lot more attention to Jerome Powell and what his interest rate expectations are. So the first thing he confirmed is that inflation has slowed down. Personal consumption expenditure was at 5.4%, so basically January of 2023 compared to 12 months prior, January of 2022. $100, what $100 would have bought you 12 months ago now would require $105 or $105.40. But its highest rate of increase, the cost of goods, was 7% last June. So after 6 months, it has come down. And inflation is actually even lower when you exclude food and energy. Food and energy because those are particularly more volatile and subject to supply chain bottlenecks, whereas the rest of the cost of goods is subject to monetary supply. So the good news is inflation is slowing down. So this means that raising interest rates should also slow down. On the flip side, low unemployment, 380,000 new jobs were added last month. But according to the Federal Reserve, there are still more jobs available than there is labor available. So the Fed's mission is to keep inflation as low as possible, ideally 2%, while at the same time maintaining this delicate balance with keeping employment as high as possible. So right now, employment is good, which means they're not really under any sort of political pressure or pressure otherwise to stop with the interest rate hikes. And then just directly quoting Jerome Powell, the committee has raised the target range for the federal funds rate a further 3 percentage points. So this was at the beginning of this month, bringing the range to 4.5% to 4.75%. So whatever the federal funds rate is, by the time it trickles down and gets lent out into the private markets to individuals and investors such as ourselves, it usually goes up another 2 or 3%. So if the federal funds rate is at 4.5%, we're probably going to get interest at 6.5% or 7% for more conventional loans. Higher risk loans and stuff will still be 9, 10, 11%. And he indicated that they anticipate ongoing increases in the target range will be appropriate. Mortgage originations have materially declined, no surprise there, but auto and credit card debt have increased. And this is interesting, is the pace of business loans, so lending to businesses, has not been affected as much, has not slowed down as much as lending to real estate, for example. My personal theory is because businesses generally generate a higher rate of return, well over 10%. There's just a lot more risk involved, a lot more operational intensity that businesses incur, so they justify and earn a higher rate of return. So as rates go up, they have more profitability that they can sacrifice, as opposed to real estate. Those rates of return on real estate compared to private equity, for example, are lower. So as rates go up, they're going to be more sensitive to it. According to Powell, financial vulnerabilities remain moderate overall. And then I had to quote this for you guys, his words, not mine. Real estate prices remain high relative to fundamentals such as rent, despite a marked slowing in price increases. So essentially, if you're selling properties, if you're a developer, if you expect to go and sell something in the open market, I'd say based on his comments, it would be wise to anticipate to sell at a lower price, to continue to be conservative. But I've highlighted here in red because this just happened since the Fed released this on March 3rd. I think this was less than a week ago. Silicon Valley Bank has gone into receivership by the FDIC, I believe. And so this is paraphrasing from his report 2 weeks ago. The banking sector is believed to be stable based on risk-based capital ratios, according to the Fed. And then 2 weeks later, SVP goes under the water. So I think many investors are sadistically optimistic that the bad news for Silicon Valley Bank might scare the Fed into not implementing further rate hikes as they had indicated. But it's still unclear, at least to me. I'm not totally sure if the issue with SVP is specific to that bank or to the entire banking system. I don't know. Maybe some of y'all have some comments. I'd be curious. Rob?
They're all doing it.
They're all screwed?
They're all doing what SVB was doing.
What was this doing?
Losing money.
There you go, that in a nutshell.
Well, I feel odd saying this, but I graduated in 2008, the Great Recession, and it was interesting seeing how interest rates impacted things then, like ARM loans and the prime rate. And there's some real estate deals I'm involved in that some people are a little bit waking up to the fact that interest rates don't stay at zero forever. And I think SVP was searching for yield, and they found yield, but they didn't pay attention to history. And from what I've read, they didn't have a chief risk officer, person in charge of managing risk for 9 months. And in those 9 months, the Fed raised rates quite a bit. So.
Yeah. I know a few sponsors in the multifamily space that were taking variable rate loans before the rate hikes. And it's variable. So by definition, you're putting yourself in a new level of risk. And for as long as rates have been low, it's an unwise decision to make. But, just to your point, yeah, unfortunately it happens. So, moving on, back to multifamily, back to underwriting. Sponsor mishap number 1. additional CapEx doesn't translate into additional yield. So from my experience inside the industry and as an investor, I'm always curious, what are the deals that don't work out? And why didn't they work out? And by far the most common reason a deal doesn't pan out as expected is because the pro forma rents, the projected rents that they hope to receive, is not what they got after already expending all the money on renovations and rehabilitation and upgrading the units. And so I think that's where you have to give your sponsor credit for those that have that deep local knowledge, because there's definitely a lot of areas. I'm actually originally from Houston, and I can tell you a lot of out-of-state investors go into Houston, they'll see a complex, it's a really good price. There's definitely a lot of potential to renovate that complex, upgrade it, make it look like new. But what they don't understand is, from the outside, the area looks okay, but you can go and make that complex look as nice as you want. The thing is, if the folks can afford to pay more money, they'd rather just move to another area than live in a nicer apartment in that same area. So that's where I think the local sponsors with local expertise and focus can have an advantage over maybe your larger, maybe more sophisticated, at least on the outside appearing more sophisticated sponsors. And that's probably been the number one biggest mishap that I've seen as far as where deals don't work out. But I want to turn it back to the audience and kind of ask, do y'all have any other scenarios you can share where sponsored deals, without using any names, have not worked out, where they didn't meet the projections, and what was the cause, so that as investors we can avoid those mistakes going forward? Yes, ma'am.
So it's not specifically to sponsors because I'm not in multifamily. Can I still address that?
Yeah, of course.
So I actually just wrote a whole article on this because in a neighborhood here in the Austin metro, in April of 2022, someone, I think it's out of state, because there were a couple other examples, they paid over $351,000 for a property, got a 70% loan on it, and are renting it out for, they hoped for $2,000, and they're only renting it out for $1,900. And just estimating the expenses, they're running a negative cash flow of almost $400 a month. Within 2 months, that same exact subdivision, same identical house, was about $295,000. And
Could you speak up a little bit?
oh, you want me to start over or
No, no.
Okay. Yeah, so within just a couple of months, that same exact house would have been about $295,000, and rent is still only $2,000. And I used it as an example because we bought a house in the same subdivision for $225,000, and with our exit strategy, it's significantly more cash flow. But just within a matter of 2 months, these people, not only did they pay the $351,000 for it, they also remodeled it on top of that, which I don't know how much they had to put into it, but it just seems extremely speculative to have done that. Whereas being local and knowing what that market is, I knew not to pay anywhere near there, and we were all in at like $225,000. So I know that that's not an isolated case, just from all of my research.
Right. Yeah, I think one of the things I appreciate most in some of the sponsors that I've invested with is when they say no. When they say, sorry, I don't have any deals right now because I can't find anything good. As opposed to some other sponsors that always have a deal, which, might be true. They might just be very hardworking and very astute in sourcing really good deals. But the ones that tell you, no, I don't have any good deals right now, I just can't find anything, they have that discipline to say, nope, not taking any money, I'll pass, and I'll kind of hang around for a while until I have something that I can make the numbers work, as opposed to, there's a lot of the sponsors, they're in the business, they make a livelihood in doing deals. And they need those acquisition fees, they need those disposition fees, they need those refinancing fees to meet their overhead. And so those are the ones that unintentionally kind of get stuck into putting themselves in more risky situations with the variable rate loans to get a deal done. But then they put themselves and their investors' capital in those scenarios where it's, okay, all of a sudden interest rates have gone up. Uh-oh, now we're in big trouble. But thank you for sharing. So,
I think people, just one other example, I don't know all the numbers, so just short and simple is another neighborhood that should still be in that, pre-COVID 250 range. They came in way over rehab the property and still trying to sell it for over $500,000. I'm like, you are so not from here to be doing that. And of course, after researching it, they were a California company that did not know the subdivision, and they still have that house.
yeah, so definitely not having the local knowledge. And then also, when interest rates are low and prices kept going up, I mean, still that doesn't justify that mistake.
But then they justify it in their head.
What's that?
They justify it in their head, and then they try and justify it to their investors. I'm going to overpay because my interest rate is so low. And then the product doesn't perform because they didn't take into consideration taxes and insurance is going through the roof. And, all the other added expenses that they don't always, that they can't control.
Yeah, I think a good deal will make you money even if you never sell the asset, meaning it's cash flow positive. Very simple. But if the deal...
Two of those, where we've gotten 250% of our original investment and still getting 12%. We were getting 18, but he decided to get his war chest and just plopped a big old chunk of money at the beginning of the month, at the beginning of the year, and said, I'm going to cut it back down to 12 so I can grow the war chest back up.
Right. Whereas, if the returns on the deal are all predicated on the exit sale, then it's a tough one. But let's move on. I got a couple more slides before I put you all to sleep. Yes, Scott?
Well, just to add to, you're talking, and I'm sure Andy can talk even more about this, but we build basically only in 2 zip codes. So we deal with only 2 municipalities, and I'm only a year into real estate construction, right? But one of my observations is we were looking at land out in Taylor area, just considering is that we don't know the inspectors, all the inspectors in our 2 zip codes. We don't know how they're gonna handle this, going through all the inspections and permitting, et cetera, but between the Austin and Lago Vista, we know exactly how that works. We don't know all the subcontractors that work out there, but we know all the subcontractors in our area, right? And also every piece of land around where we're building, we know the value, the quality, what else is going on in there. So the local builder or deal maker can know all the other risks that aren't in the formula, right? Aren't in our assets, liabilities, equity, CapEx, cash flow formula. That are all risks that can get ignored or not talked about and not then quantified. But an experienced person like you're mentioning can reduce all those risks, increase your likelihood of your yield and their profits, and make it a win-win.
Yeah. It's, I think a lot of people make the mistake of underwriting how much profit can I make first. I think the better way to do it is underwriting where are the risks,
Right.
And if everything goes wrong, do I still come out at least breaking even? And then from there, all right, which one of these deals will make me the most profit? So underwriting is not just about calculating how much profit can you make, but how much risk is there in this deal? Whether that risk is from tenants defaulting, occupancy not going up to par, rents not being able to achieve pro forma rents, et cetera, et cetera. So a couple more slides, which means I'm going to go through them pretty quick in the interest of time. But this one is a fun one, another trick question. So we've got 2 deals. Deal A on the left, it costs $100 to acquire the asset, right? So you see that acquisition on the left, cost is $100, and it yields 8%. So after all expenses, it gives us $8 a year. But we're underwriting that we're going to invest an additional $10 of CapEx to increase rents because we're providing more upgraded units, which will increase our overall yield by an additional $2. Deal B on the right. Acquisition is $95, so the asset costs us less. It also yields us a little less. CapEx is a little bit more, but the incremental cash flow growth from our renovations is also a little bit more. So the pro forma yield, the yield at the end that the sponsor shows you, which now as more astute investors, we can kind of delve behind the numbers a little bit ourselves, basically break out the total money that the sponsor is raising, whether it's debt and equity, all the money in total. How much of that is going to acquire the asset as it is versus how much of that is going to fix up the asset. So the asset as it is produces this much. The CapEx that we intend to put produces that much. So in both scenarios, they look pretty much the same. Our total cost for deal A, for example, is $110. Our total cost for deal B is $110. Our total yield for deal B after CapEx renovations is $10. And our total yield, again, for deal A is, again, $10. So between the two, they both come out the same at the end, but is one better than the other?
Oh, yeah.
And who wants to take a stab at it?
Deal B, I'll take a stab at it. Deal B is way better because you're increasing the yield by the action you took by nearly 50%. So you're showing a growth in yield to a prospective future buyer that's much higher. They're buying growth because past growth is predictive of future growth. That's my shot at the deal. That answer.
Yes, sir.
I think on the conservative side, though, deal A is safer because you have a higher yield off bat if you don't do anything. And you're not expecting as much yield off of your less cost out, which means that there's less risk in the deal. So if you put 10 bucks into it and you get 2, well, maybe you end up getting more than that. If you put 15 bucks and you think you're going to get 3, what if you only get 2? Then you're
Yep. Good point.
So I think, of course, it also depends on what the asset is. If you're buying a C class, you put 15 bucks into it, and it's reasonable, you can probably get a lot more yield out of it. So I mean, it really depends on the asset.
I like you, Scott. I like you more than Andy, but I'm going to go with Andy. Because for the reason I'll reiterate is, and again, it's just my opinion, right? I'm no authority on these matters, right? But I want to share what I've learned from the inside working for these different sponsors and groups and underwriting all these deals and building all these Excel models, what doesn't get shown to the passive investor. But I would go with deal A because the yield on acquisition in that case is $8 for the $100 that I spent. Basically, to put it simply, for me, the risk is that the CapEx, the money that we expend, the capital to improve the asset, we don't have a 100% guarantee that it's going to increase the cash flow by that much. That's always a little bit of a risk. So if more of the cash flow is coming from the asset as it is, that's why we segment out the cash flow into 2 different series. One is what it's historically shown to produce. The other is what we project or pro forma it will produce after we fix up some renovations. So they're both in US dollars, but one type of dollar is less risky because it's already proven. So I would go with deal A, like Andy said. They may come out the same at the end, but from a risk perspective, if you have 2 options, yes, sir.
There's maybe another factor, and that is the tenant base in each. If the first one implies a higher quality tenant base, which even though all other things may be equal, less drama, less hassle, something you'd rather be doing, potentially.
You will be a slumlord, Scott. We
Yeah, I agree.
Play nice, Andy.
Oh,
Tenant base as in, you mean the ability to collect rent and avoid delinquencies and vacancies?
Class C, that might be
Yeah.
Class C, and just the kind of drama you have to get involved with the residents is generally less.
Right, right. And then did you have a question, sir? No? Okay. Thought I saw a hand. Oh, and last but not least, what is the DSCR? So debt service coverage ratio. I know you guys especially know this because y'all are putting debt out there, right? But as a sponsor or as a passive investor, we assume that the sponsor has taken an appropriate amount of leverage. But I think as a passive investor, it's dangerous to ignore and do your own assessment of, is this property over-levered or not? So what I mean by that is basically how much excess cash does this property produce over its debt payments, such that, if we see a sudden fall in the rental income or whatever it may be, will it have trouble meeting its debt payments? So the lenders, they all use the DSCR ratio, which is debt service coverage ratio. And what that means basically is in this scenario, we have $100 of rental income. All the other expenses, excluding the actual debt payment, is just $50. So that leaves us with $50 left over after all expenses, but before debt. In this scenario, the debt payment is $25. So we've got $50 of cash flow. For every month, we have to pay $25 of debt service. So it's a 50 to 25. That's a 2-to-1 ratio. So the debt's DSCR is 2 times. Basically, it's the ratio of cash flow to debt payment. And the more cash flow, the smaller the debt payment, the less risk there is in the deal. One of the biggest risks, I think, in real estate is, because real estate is fairly, in terms of the risk spectrum, it's actually one of the lower risk assets you can invest in. Because it's cash flow, to an extent, it's not that hard to predict how many people are in there right now, what are they paying. There isn't that much into it when you compare it to like a medical device startup or something of the other. So really one of the main risks is not meeting your debt payments, the bank coming and taking it over, and you losing all the equity and everything that you had in the deal. So under no scenario would you ever want to invest in something that's over-levered, no matter how high the return that they're marketing or advertising, because it just doesn't justify risking losing everything. So as a passive investor, if you're presented multiple deals, which you will be, you have 3 or 4 different options. There's a number of ways that we've reviewed as far as how you can determine what's the best. Because I think, unfortunately, most people just make the mistake of, well, which one are they giving me the highest projected return? I'll go with that one. No, honestly, at the end of the day, they're all projecting you a return that's within a similar range. One guy or girl may be saying 16, 17, 18, or 17.5%. These are all fairly close. Yes, there's a difference. So at the end of the day, don't just go off of which is a higher rate of return. Instead, do your own due diligence, the factors that we mentioned, like the CapEx and things like that, but also the DSCR. And I would take a deal that is 16% IRR versus an 18% IRR any day. Why would I take a lower IRR if the DSCR ratio is significantly different? An extra 2 percentage points doesn't justify the significant amount of risk that, unfortunately, passive investors, the sponsors don't always show you these details. But last slide, just a summary slide. So, and then I can email this slide deck to anyone who wants. But questions to ask your next deal sponsor, just reviewing all the items we discussed. What's the going in cap rate? What's the exit cap rate? Current cash flow and acquisition price versus the incremental cash flow we expect to receive from renovations. population and employment trends. Do local wages support pro forma rents, right? So we can avoid that scenario where we renovated to charge higher rents, but it turns out that the folks in that area would rather just move to another area than whatever it may be. And are pro forma rents the highest in the area? So for multifamily syndications in particular, ask your sponsor, the deal sponsor, the pro forma rents that you expect to achieve. Is there another complex within a certain radius that is already renting out for this rate? If not, that doesn't necessarily mean it's a bad deal. That just means that you're the first one to go in there and bring rents up to that level. So it's a little bit of a riskier deal, as opposed to, no, we're not the first ones. There's complex B down the street and complex Y just a mile down the road are already at those rental rates. Okay, so that rental rate has already been proven in that specific market. Completely different risk scenario, and they may be offering you effectively the same amount of return. Now you know which one to pass on and which sponsor to go with. And then the other stuff we just mentioned. Last points for those who like to get really specific with the underwriting and grill their sponsors. I've had some investors who have done this to me, and I actually really appreciate it. So I feel passive investors should have no shame in annoying their sponsors. But
Tell that to the sponsors.
how much working capital or cash reserves are they starting out with? Yeah, so when the deal's closed and you've raised all your money and you've bought the asset, and aside from the cash you've set aside to renovate the units, you should have a little bit of cash that's just working capital or cash reserves, whatever you want to call it. Your emergency money, rainy day fund, how much of that do you have? And how much of that is in relation to what your monthly expenses are. So you know how much cushion, how much of a safety net this sponsor has embedded in the deal. The thing is, the bigger the cushion, the bigger the safety net, that actually dilutes the rate of return on equity. So sponsors are incentivized not to leave too much of a cushion because it'll lower the returns because you have this excess cash that's not being deployed, that's not generating a rate of return. But it could save your business, save your investment if the event ever intends. So a sponsor that shows you, oh, I've got this much cash set aside in our projections, means that sponsor is lowering risk first, then getting the highest rate of return they can, and then raising money, as opposed to raising money, getting the highest rate of return, and then worrying about risk after the fact. And our property taxes going up in the projected years, so they're projecting what this deal is going to be like. They've got to make sure, yes. So make sure that they're upping their property taxes in their assumptions. If they're not, or they're keeping them flat, then I doubt that's the scenario. But an annual rent escalations. So after stabilization, after everything's been renovated, it can really make a difference in the IRR if you increase rent every year. Everyone does, right, by about 1 or 2%. But if you do 2.5%, 3%, now you can really get higher returns, but it's not sustainable. So that's just some very more minute, specific points. And with that, we conclude. And if anyone has anything they want to share, we definitely have some experienced investors and developers, and I'm also very curious myself on the note investing side, what you guys are seeing. But just any comments in general from anyone, let's make it a bit of a discussion before we all head home. And if I could have someone else do some of the talking, that'd also be pretty great.
I do have a mic here, so if anyone does want to make comments, just let me know. Turn it around to you.
Come on, Andy, don't be shy.
Of all these factors, if you're evaluating risk as an investor, which one or two would you say are the most important?
Debt, so the debt service coverage ratio. So the more debt I add into the deal, the higher the equity return in a low interest rate environment. But to answer your question, number one is it cannot be over-levered. And number two is is more of the return coming from expectations of higher cash flows, or is more of the return coming from me just getting it at a really good price? So those two, debt, and then where's the return coming from? Cash flow today or expectations of cash flow in the future? And then also, I'd add a third one would be the sponsors. Not necessarily have they been in business for, like 20 plus years, but do they have a expertise in that specific area? Because real estate is very localized. Any comments? Anyone has any additional information from their perspectives they'd want to share?
I'm not investing in multifamily this year at all. I
And
don't care how good the deal looks, it ain't happening.
And why is that?
Because they're really, in my opinion, no good deals.
And do you think that's specific to multifamily or across all of real estate?
Specifically multifamily, the sponsors that I'm running across, they will not balance themselves. They're still willing to pay too much for the property, and with so much uncertainty, taxes, insurance, the rentals and things like that, they're telling investors what they want to hear, but if you, like I said, if you break down the deals, the math doesn't make sense. So they're not just, in my opinion, they're deliberately misleading the investors because they have a JOB, they need to collect that management fee and all the other fees that come along with it. So I'm very selective on who I invest with, so I don't invest with a lot of sponsors, only the ones that have proven themselves to me from past experience.
Yeah.
They're not going to screw the investor just to make a buck, and there's just too many of them out there that are willing to do that.
Yeah, there's definitely a boom in multifamily, but I've always been an equity investor. But once the rates started going up and yield on debt increased, debt investments all of a sudden are starting to look a lot more attractive to me. So I'm kind of curious if you guys could share, because I used to shy away from debt investments because, they always say your principal investment is being eroded by inflation. Well, in theory, we're hitting peak inflation and it should be tamed, so that's not as big of a concern. Meanwhile, you guys still have a pretty good yield, at least more so than a lot of equity investments right now. So I'm curious, y'all have anything you want to share as far as your experience with note investing in this environment?
Well, the interest rates have gone down.
Can't let the secrets out.
Yeah, the secret's out.
Well, we do, one, we buy both performing and non-performing notes. So we buy the cash flow, obviously, on the performing notes, so we already know that there's a propensity to pay. We're looking in the specific markets as to what are their jobs, what is the likelihood that they're gonna have recession issues or what have you. From a distressed note perspective, it's, not only is what is the loan to value on the underlying, on the debt itself, but what then is our investment to value, which is always gonna be significantly less than that, because we're gonna go in and instead of rehabbing the house, usually focus on the borrower first and helping them get reperforming. But then locally, we buy the distressed properties and then we convert them into notes. So like what I was saying earlier, we may buy the house significantly less because I'm buying for where the market's going, not for where it's been or where it's at. Doing a value add, and then we're selling on owner financing. So like in that example where the other people are getting, a negative $400 a month in cash flow, not to mention how much, what I can't see in that is how much did they have to put into rehabbing that property. I know where I'm at all in, so I know that when we do our notes that there's an immediate cash flow and there's a significantly low ITV and LTV on those. So on that same property, we're pulling in $2,000 a month in cash flow.
Nice.
And when you sell or finance it more recently, what have been the rates or range on those seller
For
financing?
rate hikes, we were right around that 8.5%. We're closer to 9.5% now. We still keep it affordable because we want to make sure that we're not overselling
Can you
it.
repeat that? I didn't hear that.
We were staying around that 8.5%, but right now we're closer to 9, max 9.5, just because I know that we can pull double digits in it, but I don't want to take the properties back. We're getting substantial down payments and like $60,000, $80,000 down.
Up to 20%, plus down. Plus, we don't want to set up anybody for failure. If it's too high.
Well, cash flow is hard to get in this market anyway, so
Right.
why not?
Right.
I mean, I would say there's a purpose for both equity and debt, and we've been doing in the background notes for 11, 12 years, and it's been steady, routine cash flow, and varying from 9 to 18%, and well, 8's the lowest we've taken. But I would say, I would quote one of the founders of this company, and sometimes the debt seat's the best seat in the house, because you don't have liability, it's very passive, once you get all the paperwork done, and it's relatively low risk.
Except occasionally when you have to take the property back.
Yeah, but then it's rinse and repeat. Do it
Right,
again.
exactly.
Yeah,
So
and if you
it's a
once
win-win
done it
situation.
once or twice, it's not that big a deal.
No,
Right.
it's not.
And it's, on the notes that we're acquiring, it's definitely double-digit returns,
Yeah,
on all of that.
nice.
Awesome. So I think that's it for tonight. Sarah?
Yes, thank you so much. Let's give Rosch a round of applause.
Give me the underwriter's seat.
Yes.
Yeah.
Yeah, good job.
Try to get all the perspectives here. Do we have any questions online? Okay, we do. And it is? Okay, hang on. Aside from finding under market purchases, how can we increase cash flow or find good deals with debt, insurance, and taxes all going up? I can repeat the question if you want.
No, I heard the question. I just don't have an answer.
Start our own insurance company.
Yeah.
You've been saying we should get together.
We do have one answer, and it was
Oh, I said start our own insurance company.
Well,
start an insurance
actually,
company.
You need to start a pool, which is what our investment group is doing. So,
Or start a pool, which is what some investment groups are doing.
The pool's a good idea. The start our own company.
Yeah, I mean, I would say in addition to all of that, I mean, the question was, apart from finding a really good deal off market at a low price, how do you still find cash flow when all the expenses are going up? So it's basically the question is like, if I take away everything you could possibly do to get a good deal, how do you still find a good deal? I mean, but I think it was
wait
touched
till
on.
Next year when everybody
Yeah.
starts, the bank starts taking away those deals.
Wha-
and you can
Why
buy.
notes are good. This
Yeah.
is one of the things about, and I think you're gonna see a big trend, if you isn't already there, towards owner financing, because so much of the market is predicated on the uncertainty of financing.
Right.
If you do owner financing, it takes that right out of the equation.
So there's the answer right there is open up your investment options to not just equity investments, but also debt investments as well.
Yep.
Awesome. And I think that was the only question that we had online. Do we have any more from the audience? Awesome. All right, we're going to round it up and give another round of applause. All righty. So now is the time of the night. I don't know why I did this. I don't have a watch on. But we are going to keep it pretty short because we are coming up to 8:30. But if you do have a deal or a service, feel free to come take the mic from me, come to the front of the stage, pitch that for either 30 seconds to a minute. We don't want to make it too long here, but want to give you guys an opportunity if there are any takers. Going once, going twice, 3 times, we're out. Alrighty. Well, feel free to network amongst yourselves. We'll be closing up the office here about 15, 20 minutes while we clean up. But thank you all for coming, and we will see you for Self-Directed IRA Saturday this weekend. Thank you.